This screencast is looking at Summer 2016 Question 1, focusing on the Advanced Variances element, Part E. So again, I've assumed you've read through the question fully, but if not, pause it now and go back and read through the question. We're focused in particular on Part E. So using the information provided in Appendix 2, calculate the following sales variances for ingest in respect to Q1 2016. So price and volume variances for sales, and also the sales mix and sales quantity. So again, we're all looking here at the basic sales variances, but also some more advanced ones that's core to CAP2. And note this information here, you may assume that ingest uses marginal costing, i.e. it looks at contribution per unit as opposed to profit per unit. So you should ignore fixed costs, and you're not required to provide a reconciliation statement. So that's just outlining what you should and shouldn't do. So if we go up to the question, and again, prior comments or prior screencasts I would have focused on this in the case studies, the examiner typically will give you different paragraphs for different requirements. So under nutritional supplement is the paragraph that's related to the advanced variances calculations and one or two other requirements. Essentially here that Tim is the sole owner of a new business, Ingest, which specializes in production, sale of nutritional supplements. So it's recently commenced trading, and they're looking for the first trial that was held in Q1 2016. So they've people in gyms, and they have three supplements: Ego, iGo, and YouGo. And what they're looking at is they've now given their employees some discretion in terms of the sales price, by up to 10%. And they essentially want to now do a sales variance to figure out, well, what has gone well and what has gone poorly in the first quarter. And that's essentially what you're asked to do for Part E. So again, if you haven't, pause it now, go back and read it in depth to make sure you actually understand what's going on, and then in particular here we'll focus on how to approach the calculations. So in understanding variances is a very popular question, particularly in the case study element. You should have some kind of cheat sheets. Remember, it is open book exam that you can have with you, even if it's just as an aid or a reminder of what the relationships are between some of the variances. So these are the key variances we're looking for. So to give an example of the type of thing that I expect students may have, or some version of it, if we look at something like this, what I essentially here have a version of a cheat sheet. Now it's very basic, but I don't have sales price, but sales price will be here at this level with sales volume, so two separate ones. Then once you get to the next level of granularity or difficulty, you can go to sales volume variance, can then be split into a sales mix variance and a sales quantity variance. And again, for other questions, you may subdivide that further into market size, market share. But all we're really worried about is sales price, which again is a very basic one from CAP1, sales volume, and splitting it down, should I say, that's sales volume into sales mix and sales quantity. So I typically tell students, have something like that. It won't give you the overall answers, but it'll give you an idea of what the relationship is. And you know then that when you calculate your sales volume variance, which is the difference due to different volumes being sold each year for each product, you know adding your mix and quantity variance should get you back to your volume. So that's just an idea, and we'll see the different formulas there. You can insert formulas for the other sales volume and sales price if you wish as well. But that's just a good idea to have, that if variances do come up, you have some small sheet that you can make a quick reference to. So we're going to start now doing the sales price, and let's look at Appendix 2 for the information that we're given. So the information given here, we're given actual data, so make sure don't read this incorrectly. This is actual on the top, Ego, iGo, and YouGo, and this is budget, so Ego, iGo, and YouGo. So make sure you understand which one is which, because if you mix them up, you'll get completely wrong variances. So the first one we're going to look at is sales price. Now one thing students get confused is, well, how do I go about it for each of the three? Do I try to do it in total? For any variance, you always do them separately. Do each product individually, and then bring it all together for a cumulative variance at the very end. So for the sales price variance, we're going to do separate ones for both Ego. I'll just do it E, I, and U. And that's the typical way you'll do it. Now, I'm a big fan of telling students, do the columnar method. It's the easiest one. Some students prefer to do sales price as the following. It'll be actual price minus standard price times the actual quantity. That's fine, but again, just make sure you know what a negative versus what a positive figure looks like. And what do they mean? Does it mean favorable or does it mean adverse? So depending on what way you've this structured, they can be read differently. So that's why a lot of students get confused with that. I tell students, instead of that, do actual quantity times actual price, and do actual quantity times standard price here. So two different columns, do out the calculations for both, and then compare each to get the actual answer. And I leave all figures in absolute, so no negatives or positive, or should we say all positives, and then I label either an adverse or favourable when I actually think about what one it actually is. So you'll see how this works for each of them now. So in terms of ego, the actual quantity was 9,000 unit sales, and the actual price was here, 62. So 9,000 times 62. So the more straightforward you make things, your approach to variances, the less room for error there is in the exam. While a lot of students may like this kind of shortcut formula, when you're under exam pressure, it can be very difficult to figure out, and you can get very confused very quickly, which is not what you want as an ideal start to the exam. So for ego, it's 9,000 times 62, and the actual quantity is still 9,000, that's the actual quantity you sold, but your standard price, or what you thought you'd sell it for, was 60 times 60. So the difference here is 18,000, so 558 plays 540. Now here's where students need to think about, well, is it a favourable or adverse? So I sold for 62 when I thought I'd only sell for 60, therefore it must be favourable. It's a favourable price variance because I sold 9,000 units at €2 extra or more than I expected. So 9,000 times 2 gives me 18,000 favourable. And that's essentially what that, how you can interpret that. Exact same approach. Once you know how to do one, the rest of them become mechanical. So actual quantity for IGO is 9,000 units as well. So your actual data times actual price was 71. The actual quantity again is 9,000, but the standard price this time was 75. So now again, it doesn't mind what side is bigger. I still give it, there's a positive or there's a positive figure of a difference there. Now the question is it adverse or favourable? Well, I'm looking at price. I sold it at 71, and my budget was for 75. So that's adverse. So it's just as simple as leaving adverse there. So I always tell students do something like that, because if you get messed up with negative and positive figures, you may interpret them incorrectly. Whereas if you think about it for what actually am I looking at and comparing them, it makes it a lot more easier to interpret whether it's an adverse or favourable variance. Final one then, very mechanical again, same thing, 10,000 units actually sold for Yugo times 90, whereas there was 10,000 units actually sold is the same, but we budgeted 100. So again, there's a difference there of 100,000. Put that down. And again, the actual selling price was lower than the budgeted, therefore it must be adverse. I'll put the adverse there. And remember, you're asked for the total, so make sure you add them up, and make sure you're careful in terms of that's adverse, and you take away the favourable one, or of course you could go vice versa. But the whole idea is that the overall variance is 118,000 adverse, or should I say adverse. Okay? So note, in this question, if we go back to the requirements, you're not actually asked to interpret. So this is core calculations, you don't need to interpret, but just for the tutorial purposes, this essentially means that overall, while you did sell Ego at a higher price than budgeted, this was outweighed by selling both IGO and UGO at much lower prices than expected. Okay, so the overall sales price variance means you lost out on €118,000 for selling goods at a price less than expected. But of course, the whole relationship in basic economics is if you sell it for a lower price, you hope to get bigger demand. So now what you're looking at is the next thing is sales volume. So sales volume variance looks at, well, did you sell more or less units than expected? And again, we're doing the same structure. It's E for Ego, I for IGO, and U for UGO. And in this case, now be very careful here. You're looking at a slightly different one here. You're looking at actual quantity times standard contribution per unit plays standard quantity times standard contribution per unit. So unlike things, you're not taking the price now, you're taking, particularly for sales is the only one compared to labour or compared to materials variances. Here you need to take standard contribution per unit. And this is why you're told this here, they use marginal costing. So you're not looking at profit per unit. So if you used an absorptional costing system, it will be profit per unit, but because you're using a marginal costing system, it's contribution per unit. So that is basic CAP1, so make sure to go back and look at your Clark Purple Management Accounting textbook if that is not making sense to you. So we'll do a quick calculation here. Standard contribution per unit, so that's the budgeted one, for E, I and U. So you go back to the question and the appendix. What is the contribution per unit budgeted, which is the same as standard here? It's 60. We expect to sell for 60 for pack, minus the variable costs of 25 and 8. Right? So standard contribution per unit for EGO is 27, and the same approach now for IGO. It's 75 minus 35 minus 10, so all along here, and then 100 minus 50 minus 30. So again, a lot of students would have made the mistake of including their fixed cost per pack, but because it's a marginal costing system, you need to ignore that and only use your variable costs. So 27, 30 and 37. And now, as I said, it's a very mechanical approach again. You take the actual quantity sold. So for EGO, it was 9,000 units actually sold times 27. And that plays, the standard quantity was 10,000 units sold times 27. So the 9,000 actual sold, 10,000 expected to be sold. So there's a difference there of 243. And again, ask yourself now, was that a positive or negative impact on profits? Well, you actually sold 1,000 less than expected, therefore it's adverse. So because you sold 1,000 less than expected, you had an adverse sales volume variance. You lost out on profits because you made less sales. Alright. Next one, same approach again. So once you know one, it should be fairly routine after that. Actual quantity for IGO is 9,000 units, as per here, times 30, being the standard contribution per unit. 9,000 units again. Apologies, this is standard quantity, which is 8,000 units times 30. So in this case here, the difference is 30,000. Now again, pause and ask yourself, is that a favourable volume variance or adverse? So did we sell more or less than expected, and will that boost or take away from profits? Well, you only expected to sell 8,000, you sold 9, so you sold 1,000 extra units at a budgeted contribution of 30 per unit. So that is favourable. And the final one then is 10,000 actual units times 37 for UGO, compared to what you expected to sell was only 7,000 units times 37 for UGO. So the difference there is 111,000. And again, ask yourself, is it positive or negative? Well, you only expected to sell 7,000. You sold 10,000, so you sold 3,000 extra volume. So again, that's going to have a positive variance. It's going to be favourable. So as I said, similar enough to sales price. Once you know the formula, it's very methodical after that to bring it down. And then of course you add them up. So I do favourable plus favourable, and again take off the adverse, or you can do the opposite. So that's 114,000 favourable. And that's your sales volume variance. So again, they are really only a recap of CAP1 variances. There should be nothing overly complex there, and if there are, you need to go back and look at the CAP1 material for basic variances. One thing again, I told you, you're not asked for the comments in the question, but look at the relationship here. You can see here where you have a favourable price variance, so you sold for more than expected, you had an adverse volume variance. And likewise, or conversely, where you had adverse price variances, where you sold for less than budgeted, you had favourable volume variances. So this essentially is consistent with the whole idea of price and demand, that if you upped the price, you sold less, and if you reduced your price, you sold more. So again, you weren't asked to comment here, but the good students should be able to make those links and be able to tell that story of what the relationships are between various variances. Alright, so looking back at the requirement, that is the first two, sales price and sales volume. And now we want to split this sales volume variance, which is 114 favourable, into, based on here, sales mix. So what was the part of the sales volume variance due to selling different mix of products? So did we sell more Ego compared to Yugo than expected? And the sales quantity variance. And this really captures the change of the actual level of units. Did you just sell more units or less units than expected? And one thing I tell students is there's various formula approaches that you can use for sales mix and sales quantity. But I always tell students to use something such as this. This is a tabular approach. Now you can see the slide here discusses it in the context of materials and labour, but material mix and material yield, they can use the exact same structure for sales mix, sales quantity. You compare actual quantity, actual mix to actual quantity, standard mix. So the benefit of having a table like this is you have a little cheat sheet approach, and you have a very structured approach that you can fill in numbers as you go along. And it's very hard to make a mistake then, that as long as you can slot in the numbers, eventually the variance will fall out at the end. So the key differences are here. This will not be standard price because it's sales variances, it'll be standard contribution per unit. That's the only main difference here. You can still use your tabular approach, but this will not be standard price. When it's materials and labour, it would be, but for sales, it will be contribution per unit, standard contribution per unit. So let's take this approach. So what I'll actually do is I'll snip this and bring it into our Excel. So hopefully this, apologies for the delay. I'll just snip this and we'll bring it into the thing so we can see what the actual formulas are. So what you're doing now is the sales mix. We compare for E, that's Ego, Igo and Yugo. We figure out what the actual quantity, actual mix is. We compare that to the actual quantity, standard mix. We get the difference. We figure out what the standard contribution per unit is, and that gives us our variance. So again, once you've done this once or twice, and you've plenty of past exam questions to practice on, it becomes second nature. So just watch it through and figure out how things slot in. So what does AQAM mean? It really means what was the actual quantity sold in the actual mix. So you have those in the question. What was the actual quantity sold? The actual quantity sold for each of them in the actual mix was the 9, the 9 and the 10. So there's nothing more complicated than that. 9,000, 9,000 and 10,000. So that's essentially saying it's the actual quantity, the 28,000 units, and it's in their actual mix, i.e. 9, 9 and 10. So that's the first part, is actual quantity, actual mix. The second portion that you compare this to get the sales mix is actual quantity, standard mix. So you can see the only thing that changes, as I point out here, actual quantity stays the same. The only thing you're changing is the mix involved. So the total will still be, put over here, it'll still be 28,000. The only thing that changes now is the mix of what you sold. So now the question is, well, what is the standard mix? And how do we figure out what the standard mix is? Well, we go back to the budget and we use this relationship 10 is to 8 is to 7. And we use those relationships, so we get those percentages, and we apply it to the actual quantity. So we get here the standard mix for E, I, and U is 10 is to 8 is to 7. So we're not interested about the total amount as so much as what is the ratio of the mix. So what percentage of this mix would be expected to be sold as Ego? They expected to sell 40%. They expected to sell 32% of all sales would be Igo, and they expected to sell 28% as Yugo. So that's what you call the standard mix, and if you ever have to do those, you're more than likely going to have to calculate that for yourself. It won't be given to you. So using that relationship then, this was what the relationship was, 9:9:10. But if you were using the standard budgeted mix, it would have been 28,000 times 40 for ego, 28,000 times 32 for IGO, and 28,000 times 28% for UGO. So when you sum them up, you can see it's still 28,000. It's just done in a different mix. So now that's essentially the main part of your calculation for sales mix done. You now compare what it was to what it would have been if it had been the standard mix. And this is a difference of 2,200 units. This is a difference of 40 units, and this is a difference of 2,160. So again, you'll notice before I do not put positives or negatives. I leave them all positive, and now I do adverse or variances, or adverse or favorable here, and it just helps me make sure I don't mix up what a negative or positive figure is. So now you go back and ask yourself, well, what did I actually sell? I actually sold 9,000 units of ego. If based on budget, I would have expected to sell 11,200 for total sales of 28,000. So I would expected if I was selling 40% of my total sales of ego, I should have sold 11,200. I only sold 9, therefore that's an adverse variance. I sold less than I would have expected based on the standard sales mix. Here I actually sold more IGO than I expected, so that's favorable. And similar here, I sold a lot more UGO than expected, so it's a lot more than 28%. So for example here, 10 over 28,000 is 35%. So if my total sales mix 36% rounded was UGO, whereas I only expected 28 based on budget. So these are now your differences. You slot in here to quad, because remember that's only in unit terms. We wanted in monetary terms. So you put in the relevant contributions per unit, which is 27 for IGO, 30 or ego should I say, 30 for IGO, and 37 for UGO. So again, if you are struggling here, go back and make sure you re-watch it and see can you understand your method compared to how I use the tabular approach. And now it's simply using your variance is your number of units times your standard contribution per unit. And you pull those down. So for each of them, it's the number of units times the contribution per unit. And again, don't forget to label. And of course, the labels that are used here will be the exact same here. If it's adverse 2,200 units, it must be an adverse monetary amount, and so on and so forth for IGO and UGO. So total variance here then is add the two favorable and take off the adverse, giving you an adverse variance, should I say favorable? A favorable variance of 21,720. So again, remember you weren't asked to comment here, but typically in a lot of questions you will be. And you're essentially saying here is, well, based on the mix, we sold a lot less of ego than expected, but we sold more of IGO and UGO. And you'll notice here we sold more of the more profitable ones, and we sold less of the least profitable one. Hence, overall, it was a net positive benefit. And that's the kind of thing you're looking for, is selling more of the more profitable ones in the sales mix was obviously good, and that outweighed selling less of the ego product. I mean, you weren't asked for the comments there, but it is useful to be able to articulate what the actual variances mean. So remember now, go back to your relationship. We know the sales volume variance in this case is 114,000. We've calculated the sales mix variance to be 21,720. So that means we already know we need to get our sales volume variance, or sales quantity should I say, to be 92,280. So you already know before we go that's what the answer should be, and that's the benefit of having these cheat sheets and knowing those relationships. So let's go back and do the same thing again. Same approach, tabular approach, it's just this time we take a small bit of a different columns to compare. So I'll just copy this in again, just so we can use it. And let's set up a similar table than up here. So it's down here. and I'll call this sales quantity. So I'll delete some of these because these will change. These may change, and of course the contribution per unit may change. So what we're looking for now is the sales quantity is standard quantity standard mix compared to actual quantity standard mix. So in this time the standard mix stays the same, so we're not looking at changes in mix anymore. That was for up here. We hold that constant. Now we change the quantity. So you have actual quantity standard mix, and that is from above, so don't reinvent the wheel. These are the same and they will always be the same. Just pull them down. So you have that work done already. You have actual quantity standard mix done. And now you need to figure out what standard quantity standard mix is. This is essentially your budgeted figure. What was the standard quantity expected in the standard mix? And you can get this from Appendix 2. The standard quantity would have been 10,000 units for EGO, 8,000 units for IGO, 7,000 units for UGO. So the budgeted data for 2016. So now notice that the quantities are not the same because again we're comparing budget to actual. So same approach as before, you look at the differences, 1200 units, 960 units, and 840 units. So I put all in positive again, and I use my own labeling system here. So I'll just delete them, they could be wrong. So I'm asking myself here, okay, based on the standard quantity, standard mix, I expected to sell 10,000 units. I actually sold 11,200. This must be favorable, because remember at sales, I sold more than expected. Similarly here, expected to sell 8, sold 8,960, therefore that's favorable as well. And the same here. So right throughout all the products, I sold more than expected. Holding constant the mix, I just sold more in general units than budgeted. So these stay the same. Standard contributions per unit will be 27, 30 and 37. They do not change. And that allows you then to calculate each of the variances. Favorable, so this is wrong, 960 times 30 and 840 times 37. And each of them then will be favorable, favorable and favorable. So you can add them all up because they're all favorable, and you can see then that the 92,280 matches up here. So when you add the 92,280 to the 21,720, you get your 114,000. And again, this matches the relationship between the sales mix variance and the sales quantity. This explains how much of the change in how much of the profit impact was due to changes in sales mix, and this is just due to the change in the number of units sold overall. So again, you weren't asking this question to make any comments, but prior exam questions have asked you to make comments, so it is useful to be able to practice and be able to interpret what the variances actually mean. If we have a quick look at the solution, just the examiner feedback, see most candidates scored very well, number achieving full marks. So remember, full marks here would have been 13 marks, 13% of your paper. So if you put your effort into variances, use one or two good, nice, small cheat sheets, you could have got a very good mark and a very good confidence builder coming off question 1. So it is worth putting the effort in. As well as that, however, some candidates had basic errors. Some used profit, even though you were told there's a marginal contribution system. Alright, and some candidates use selling price rather than contribution. So you need to go back. That gives an idea or gives an impression that students just did not practice these questions. And as shown here in this cheat sheet, a number of these questions have come up before that you can practice on, and they're very popular in the case study question. In particular, a very similar question to the Summer 16 question 1 also appeared in Autumn 14 question 1. So if you do want to go back and practice these types of questions, look at Autumn 14 question 1, which are very similar, but it also looked at, I think, market size and market share. So this screencast looked at Summer 16 question 1 part E, focusing on advanced and basic sales related variances.